If I told you that most billionaires don't invest the way you have been taught, would you believe me? Most people assume the ultra wealthy just buy better stocks, more real estate, and smarter funds. But when JP Morgan studied families worth over 100 million, they found something most investors never expect. The majority of their money isn't in stocks or bonds at all. They are playing a completely different game with completely different rules. And here's the part that matters to you. Copying this strategy blindly can destroy your portfolio, but understanding why they invest this way could protect you. Today, I'll show you where billionaire money actually goes, why this strategy works for them, and the one part of it that may finally make sense for regular investors. Let me start with a question. If you had to guess, what percentage of a billionaire's portfolio do you think sits in regular stocks and bonds? 50%, 60%, maybe even more? Here's the actual answer. According to JP Morgan's latest survey of ultra high net worth families, people with over 100 million, only 38% of their wealth is in traditional investments. That includes 26% in public stocks, 12% in bonds, 8% in cash. Less than half. So where does the other 62% go? This is where most investors stop paying attention and where the real lesson begins. The largest allocation, 17%, goes to something called private equity. Another 15% goes to real estate investments, 5% to hedge funds, 5% to venture capital, 4% to private credit, and small amounts to commodities and infrastructure. Now, compare this to the average investor. Vanguard's research shows that typical investors have 65% in stocks, 25% in bonds, and 10% in cash. It's almost the complete opposite. Now, this raises a crucial question. Are wealthy people smarter than the rest of us? Or is there something else going on there? To understand this, we need to think about what wealth actually means. When you have 100 million, your relationship with money is fundamentally different. Let me explain what I mean. If you are worth 100 million and need 2 million per year to maintain your lifestyle, you could set aside just 40 million in safe investments, earning 5% annually. That generates your 2 million lifestyle cost forever. This means you have 60 million left over that you can afford to take massive risk. Even if half of that 60 million disappears in risky investments, your lifestyle doesn't change at all because your basic needs are already covered. This is what we call risk capacity, and it's completely different from risk tolerance. Most of us have low risk capacity. If you have 1 million saved for your retirement and you lose 300,000 in a bad investment, that could delay your retirement by years. It affects your children's education, your quality of life, everything. But for someone with 100 million, losing 30 million is disappointing, but doesn't change their fundamental lifestyle. They are still incredibly wealthy. Now, this fundamental difference allows them to invest in things that are highly illiquid, locked up to 5 to 10 years, extremely volatile, require massive minimum investments, have uncertain outcomes. But here's the thing, and this is crucial. Just because they can take these risks doesn't mean they should, and it definitely doesn't mean you should. Let me tell you about private equity, since it's their largest alternative allocation. Private equity sounds glamorous, right? You are investing in the next SpaceX, the next big unicorn company, but here's what they won't tell you. In venture capital, 6 out of 10 companies go completely bust, total loss. 3 out of 10 barely survive and might break even after 5 to 10 years. Only 1 out of 10 actually succeeds. And even if you pick a winning private equity fund, which is nearly impossible, the fees are astronomical. The average private equity fund charges 6% per year in total fees. That's before you see a single dollar of return. Here's a shocking statistics. A 2020 study found that only 34% of top performing private equity managers were able to repeat their success in the next fund. Past performance means absolutely nothing. Hedge funds? Even worse. Despite charging 2% management fees plus 20% of profit, the average hedge fund has underperformed a simple 60-40 stock bond portfolio over the last 20 years. Real estate, if you already own your home, you might already have 50 to 90% of your wealth tied up in property. Adding more real estate exposure might actually increase your risk, not reduce it. So why do wealthy people keep investing in these things if they are so problematic? Here's something I have observed after working with high net worth clients for over 17 years. Wealthy people often make irrational investment decisions for psychological reasons. Think about it. If you are someone like a successful entrepreneur who built a billion-dollar company, you didn't get there by accepting average returns. You got there by taking massive risks and being exceptional. When someone like that sits down with an investment advisor, they don't want to hear about boring index funds that any regular person can buy. They want exclusive opportunities, complex strategies, something that matches their self-image as exceptional. It's like Roger Federer looking for investment advice. He's not going to settle for average returns that anyone can get. He wants the most exclusive, most expensive advisors offering the most complex solutions. But here's the irony. In investing, unlike in tennis, the simple approach usually wins. The wealthy also have access to opportunities that aren't available to regular investors. They get invited to exclusive deals, they have networks that provide inside information, they can afford to hire teams of experts. But just because they have access doesn't mean these investments are better. Often, they are just more expensive and more complicated. Now, there is one area where wealthy investors have had a genuine advantage for decades, and it's something most people have never heard of: structured notes. Structured notes have been the secret weapon for private banking clients for over 30 years. If you walked into any Swiss private bank with $10 million, structured notes would be one of the first thing they would offer you. But what exactly are they? Think of a structured note as a plain sheet of paper. You tell the bank exactly what you want: your return target, your risk tolerance, your time horizon, and they create a custom investment product just for you. It's like having a tailor making a suit specifically for your body instead of buying something off the rack. And here's how they work. Let's say you want exposure to the US stock market, but you're worried about losing money if there's a crash. Certain structured notes can give you 100% of the upside when markets go up, while protecting your capital unless markets fall, let's say by more than 40%. Or maybe you want a steady income. A structured note can provide you with 8% annual payments while protecting your principal, backed by institutions like JP Morgan or Goldman Sachs. The key difference is customization. Instead of choosing between existing products that might not fit your needs, you are getting something built specifically for your situation. For decades, these were only available to ultra-wealthy private banking clients with minimum investment of 1 million or more. The banks kept them exclusive because they are incredibly profitable and they wanted to reserve them for their biggest clients. But here's what has changed. Technology and regulation have made these accessible to a much broader audience. What used to require 1 million can now be accessed with 50,000. Now, this is genuinely revolutionary. For the first time, regular investors can access the same level of customization and sophistication that was previously reserved for the ultra wealthy. Now, I want to be very clear about something. I'm not suggesting you should copy wealthy investors by putting money into private equity or hedge funds. For most people, that would be financial suicide. But structure notes are different. They solve real problems that regular investors face. Most investors are forced to choose between growth and safety. Stocks for growth but with crash risk, or bonds for safety but with inflation risk. Structure notes can provide both in a single instrument. When you buy a mutual fund or ETF, you are getting a one-size-fits-all solution. Your risk tolerance, time horizon, and goals might be completely different from other investors, but you are all getting the same product. If you retire right before a market crash, it can devastate your portfolio. Structure notes can provide downside protection during those critical years. Let me give you a real example. During the 2022 market crash, when the S&P 500 fell by 25%, many of our clients with structure notes saw their capital fully protected while still earning positive returns. Now, this isn't about getting rich quick. It's about having access to the same level of sophisticated risk management that wealthy families have used for generations. What we are witnessing is the democratization of sophisticated wealth management tools. For too long, there has been a two-tier system: basic products for regular investors and sophisticated solutions for the wealthy. Now, this gap is finally closing. But here is what you need to understand. Just because these tools are becoming accessible doesn't mean they are right for everyone. Structure notes require a different way of thinking about investing. You need to understand concepts like barriers, participation rates, and underlying assets. You need to be comfortable with products that might be less liquid than traditional investments. Most importantly, you need to work with advisors who truly understand these instruments, not just salespeople pushing products. I have seen too many investors got burned by poorly designed structure notes sold by people who didn't understand them. The key is education and working with genuine experts. The wealthy have always had one major advantage: access to independent, fee-based advice rather than commission-driven sales. They pay for expertise, not products. This is changing too. More advisors are moving to fee-based models where they are paid to give advice, not to sell products. This alignment of interest is crucial. So, should you copy how the rich invest their money? For 95% of their strategies, absolutely not. Private equity, hedge funds, venture capital, these are expensive, risky, and often unnecessary complications that can destroy wealth rather than build it. But there's that 15%, the sophisticated risk management tool like structure notes, that can genuinely add value to a well-constructed portfolio. The key is understanding the difference between what wealthy people do because they can afford to take risk and what they do because it actually makes financial sense. My advice: start with the basics. Build a solid foundation with low-cost, diversified investments. Then, and only then, consider adding sophisticated tools like structure notes to enhance your risk-adjusted returns. The democratization of wealth management tool is one of the most exciting developments in finance today. Now, regular investors can access institutional quality solutions. But remember, with great power comes great responsibility. These tools can enhance your portfolio, but only if you understand them and use them correctly. The rich are not rich because they use complex investments. They are rich because they understand risk, they have access to quality advice, and they make decisions based on their specific circumstances rather than following the crowd. That's the real lesson we should learn from them.